Hello and welcome. As we head into the new trading week, the market is currently closed for the weekend. The final print for AiRWA Inc., trading under the ticker YYAI at the close of Friday, October 24, 2025, was a devastating $0.0794 per share. This represented a staggering single-day loss of 14.99%, a figure that would be alarming for any stock, but is especially brutal for one already trading in the sub-dime category. This wasn't a quiet fade either. It was a high-volume event with 469 million shares changing hands, well above its already inflated average. The after-hours session showed no relief, with the price drifting even lower to around 0.076. Now, many traders are looking at this, seeing that 15% drop, and thinking one of two things. It is either a spectacular bottom-fishing opportunity on a company that just pivoted into Web3, or it is the final nail in the coffin. The expectation is that a stock this cheap with a new AI and RWA-focused name is a coiled spring. The reality, however, is that this 15% drop is not the story. The real story, the one that defines this stock's entire existence right now, is what is scheduled to happen tomorrow, Monday, October 27th, a 1-for-50 reverse stock split. This single corporate action reframes everything we just saw. That 15% drop on massive volume was not just panic, it was a desperate last-minute exit by anyone who understood what was coming. The entire narrative of this being a cheap AI play is an illusion. The reality is this is a company in a desperate fight for its NASDAQ-listed life, and it is using the most feared tool in the retail investor's handbook to do it. Let's establish the common ground. If you've been following YYAI, you probably got interested in early October. On October 6th, this stock was trading at $2.51. The next day, the company, then known as Connexa Sports Technologies, announced a complete pivot. It was changing its name to AiRWA Inc. to focus on Web3 and the tokenization of real-world assets, or RWA. It announced its AiRWA exchange and, to top it off, claimed a $100 million confirmed investment from a partner, Jucoin, and the receipt of $30 million in Solana tokens. This was the ultimate 2025 era hype package: Web3, AI, RWA, crypto, and a 9-figure investment. The expectation was set. This was the ground floor of the next big thing. But here is the challenge to that belief. From that announcement day high of over $2.50, the stock has collapsed 96.8% to Friday's close of $0.0794. The good news was the absolute catastrophic peak. The market did not just sell the news, it rejected the news with extreme prejudice. This brings us to last week's brutal price action. The volatility was almost unbelievable even for a penny stock. On Wednesday, October 22nd, the stock exploded upward by 133.75% on volume of 2.47 billion shares. This was the final desperate trap. Traders piled in, seeing the low price and the recent news, thinking the rocket was finally launching. Then on Thursday, the trap sprung. The stock collapsed 50.61% on 1 billion shares. And on Friday, the follow-through, that 14.99% drop on 469 million shares. What is so telling about Friday's action, as seen on the intraday chart, is that it gapped up at the open to $0.097, even hitting the 10-cent mark. This was the last gasp of the buy the dip crowd. And from that 10 a.m. high, it was a waterfall of selling for the next 8 hours, closing near the absolute low of the day. This is a chart that shows a complete and total failure of buying pressure. Any rally was met with a wall of sellers, likely those who knew the reverse split was imminent and needed to get out at any price. Now, we must talk about the short selling activity because it is the other half of this story. The expectation is that a stock with this much hype must be under attack by dumb short sellers. The reality is that the short sellers in YAI are operating with extreme conviction. According to the most recent data from Fintel, YAI has a staggering short interest of 56.50% of the public float. Let's be clear, this is an astronomically high number. More than half of the company's tradable shares are sold short. This is not a small, skeptical position. This is a massive, coordinated bet that the stock's value is heading towards zero. The shorters are not just guessing. They are paying for their conviction. On Friday, the borrow fee rate, the annualized interest shorters must pay to borrow the shares, was reported to be as high as 82.35%. Think about that. You would have to be incredibly confident in your thesis to be willing to pay an 82% annual rate on your position. The short volume ratios from FINRA tell the same story. On Thursday, 54.87% of all off-exchange volume was short selling. On Wednesday, it was 59.69%. The majority of the trading in this name is from actors betting on its decline. So what is the short thesis? It's simple, and it has nothing to do with whether Web3 is a good idea. The thesis is based on the company's fundamentals and its technical situation. First, the company was Connexa, a company that was already struggling with the Nasdaq's minimum bid price requirement as far back as last year. This pivot is seen by many as a last-ditch Halle Mary to create a new narrative. The second is that the short sellers knew the reverse split was coming. Reverse splits are, historically, incredibly bearish events. They are a cosmetic fix, not a fundamental one. Third, a look at the SEC filings shows a constant stream of Form 144s, which are notices of proposed sale of securities by insiders or affiliates. While the hype was being pushed, insiders were signaling their intent to sell. The 2.47 billion share volume day on Wednesday was likely the final exit liquidity for many of them. For investors at home, it is critical to know how to track this. You can find short interest data directly from Nasdaq, which publishes it twice a month. You can also use financial data providers like Fintel or S3 Partners to see borrow fee rates and short volume ratios. When you see a borrow rate spike above 50% or 100%, it signals that the shares are in such high demand by shorters that lenders can charge anything they want. It is a sign of a high conviction bearish bet. What's your take on this? Are the short sellers, with a 56% position, right to bet against this Web3 pivot, or are they just capitalizing on the reverse split? This is not a setup for a short squeeze in the way many retail traders think. The short sellers are holding all the cards. They are betting on the post-split collapse, which is a historically reliable trade. So what is this company? AiRWA Inc., formerly Connexa, is a holding company. Through its subsidiaries, it claims to own patents for digital matchmaking and other tech. The new pivot, however, is all about the AiRWA exchange for tokenized assets. The problem is that the market has valued this new venture, including its $100 million confirmed investment and $30 million in Solana tokens, at almost nothing. The company's total market cap on Friday was a minuscule $1.15 million. The market is screaming that it does not believe the hype. The 52-week range for this stock is $6.33 to $0.067. That $6.33 high is a ghost of a past life. The current price is firmly at the bottom of that range. On retail forums like Reddit and X, the conversation is not one of excitement. It is one of pure confusion and frustration. People who bought the $2.50 news are now asking what happened. The new buyers at 0.10 cents are now asking about the reverse split. The sentiment is broken. Based on this massive drop from over $6 to under 8 cents, comment below what you think the biggest mistake was for early investors in YAI. Was it believing the initial AI hype, or was it a failure to read the SEC filings? Looking to the future, there is only one event that matters: tomorrow's 1 for 50 reverse stock split. Here's what that means. If you held 10,000 shares on Friday, worth $794, you will wake up tomorrow morning with only 200 shares. The price of those shares will be adjusted accordingly, so the stock should, in theory, open at $3.97, Friday's close of $0.0794 multiplied by 50. The expectation from the company is that this new higher price will make the stock look more serious and will satisfy the Nasdaq's $1 minimum bid price rule. The reality, as any seasoned trader knows, is that this is a technicality. The company's value has not changed. And what almost always happens next is that the stock, now trading at a fresh new price of $4, simply starts to fall all over again. The shorters who covered their positions at $0.08 will simply open new short positions at $4, $3.50, and $3. This split creates new air for the stock to fall through. The risk of delisting is not